$4 trillion. Because what you just witnessed was not a normal market bounce. This was not retail buying the dip. This was not hope returning. This was a violent reversal driven by forces most people never see, while millions of small investors were panic selling at the exact worst moment. If you blinked, you missed one of the most important signals the market has sent in years. And what happens next could decide where money flows for the rest of this cycle. In the last 30 hours alone, gold and silver recovered nearly $4 trillion in combined market value. Gold jumped more than 10% from its lows. Silver surged close to 20%, then partially restored in hours. That kind of move does not come from emotion. It comes from power. It comes from institutions, central banks, and algorithmic capital stepping in after forced selling is complete. And if you don't understand what just happened, you are at serious risk of repeating the same mistake again. Before we go deeper, take 1 second to like this video and subscribe to the channel if you want clear, logic-based market breakdowns without hype. It helps the channel grow, and it tells the algorithm you want real analysis, not noise. This is Past and Profit, and our goal is simple: help you understand what's actually happening behind the screen prices. Now let's talk about what that $4 trillion recovery really means. Markets don't drop the way they did recently because fundamentals suddenly disappear. They drop because leverage breaks, margin calls hit, positions are forcibly liquidated, funds are forced to sell whatever they can, not what they want. That's exactly what we saw. Stocks sold off, metals sold off, crypto sold off. Everything went down together, not because everything became worthless, but because liquidity was demanded all at once. During that phase, retail investors do what they've always been trained to do. They panic. They sell at the lows. They assume something is wrong with the asset itself. Meanwhile, the strongest hands in the market wait patiently. They let the liquidation finish. And when the selling pressure finally exhausts itself, they step in with size. Retail does not move $4 trillion in 30 hours. Pension funds do. Sovereign wealth funds do. Central banks do. This recovery was not emotional. It was surgical. And here's the part most people still don't get. The volatility wasn't the danger. Violent sell-offs are how strong players reset positions and trap weak hands. What you saw was forced liquidation on the way down, and the early stages of a short squeeze on the way back up. Gold pushing back above key levels, silver snapping higher after being crushed. That's not random, that's positioning. Now zoom out for a moment and ask yourself a simple question. If gold and silver were truly broken, if their long-term thesis was dead, would trillions of dollars rush back in within 30 hours? Or would price stay flat and weak? Markets vote with capital, and capital just spoke very loudly. At Past and Profit, we've been saying this repeatedly. The paper price you see on a screen is not the same thing as the real price of metal. Paper markets are leveraged. They are speculative. They are designed for trading, not ownership. The real price is what it costs to actually get physical metal into your hands. While paper prices were crashing, physical demand did not disappear. In several parts of the world, it increased. Buyers stepped in quietly. Vault inventories continued to fall. Premiums stayed elevated even after prices dropped. That tells you something very important. The underlying demand never left. Only weak leveraged positions were flushed out. And this brings us to the bigger picture, because this $4 trillion reversal did not happen in isolation. It happened in the middle of a global power shift that most investors are completely underestimating. Gold is not just another asset. Gold defines confidence in currencies. It defines trust between nations. And it plays a central role in how global power is structured. That's why central banks don't trade gold like retail traders do. They accumulate it strategically, often quietly, and often far more than they publicly admit. Over the past few years, we've seen a clear trend. Precious metal pricing power is slowly shifting east. Countries that want monetary independence are increasing gold reserves. Countries that want long-term stability are reducing reliance on paper promises. China, in particular, has been extremely methodical. Official numbers show moderate buying. But trade data, import flows, and supply chain analysis suggest something very different. Accumulation on a scale far larger than what's publicly reported. Gold moving into long-term storage, not trading inventories. This matters because whoever controls gold supply and demand influences pricing power. And pricing power influences currency strength. This is not conspiracy theory. This is how monetary systems have worked for centuries. Now connect that to what just happened in the market. A forced liquidation event hits, paper prices collapse, weak hands sell, and right at that moment, massive buyers step in and absorb supply. 30 hours later, $4 trillion is back on the table. That's not coincidence, that's preparation meeting opportunity. At the same time, stress is building elsewhere in the system. Government debt levels are extreme, bond markets are under pressure, yields are rising. We've already seen signs of that stress spilling into equities. Large drawdowns don't start with crashes, they start with cracks. When traditional financial assets wobble, capital looks for safety. Not safety as in low volatility, but safety as in real, scarce assets that can't be printed. That's where gold and silver come back into the picture. Silver, especially, sits at the center of this tension. It's both a monetary metal and an industrial necessity. It's required for electronics, energy infrastructure, and advanced technology. You can't replace it easily, and you can't scale supply quickly. That's why physical shortages matter more than paper charts. Vault drawdowns matter. Delivery months matter. Inventory data matters. Because when physical supply tightens while demand rises, paper prices eventually have to catch up. Manipulation works until it doesn't. And here's the uncomfortable truth. Most people only realize this after the move is already well underway. They sell at the bottom because fear feels rational in the moment. Then they chase at higher prices because regret feels worse. The $4 trillion recovery in 30 hours was a message. It said the forced selling phase is over, at least for now. It said strong hands are positioned. It said the floor is not where panic sellers thought it was. Does that mean markets go straight up from here? No. There are real risks. Rising yields create pressure. Global liquidity is tightening in some areas while expanding in others. Volatility will continue. Anyone telling you otherwise is lying. But volatility does not invalidate the long-term thesis. It reinforces it. Because every violent shakeout transfers assets from emotional holders to strategic ones. As we move forward, watch the behavior, not the headlines. Watch who is buying when prices fall. And watch how fast value returns after sell-offs. Watch physical markets versus paper markets. That's where the real signals are. This is not about getting rich overnight. It's about understanding cycles, positioning intelligently, and not letting fear make decisions for you. At Past and Profit, we don't tell you what to buy or sell. We help you understand the game being played so you can decide how you want to participate. So here's where we are right now. $4 trillion recovered in 30 hours. Gold up sharply from the lows, silver rebounding aggressively. Forced liquidation behind us, short covering underway, and long-term buyers still accumulating. At the same time, systemic risks are growing in debt markets, currencies, and equities. Two forces pulling in opposite directions. Paper volatility versus physical reality. Which one wins? History suggests the real assets eventually do. If you found this breakdown useful, drop a comment and let me know what you think happens next. Does this recovery continue, or was it just the first warning shot? Share this video with someone who panicked sold the lows, because understanding this could save them from repeating the same mistake. And remember, don't follow anyone blindly. Use your own brain. Question everything. And stay focused on profit with perspective. This is Past and Profit.